Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. We've had two patterns here, two completed patterns that have been the main influence on this market since as far back as summer last year. The first pattern is an overextension of the bright red neckline, which is currently at 446.5, of the May to August 2025 Head and Shoulders continuation pattern. The bright red neckline also shows up in the second pattern. In this case, it acts as a lower trend line, together with a nearby upper trend line that together formed a shallow July to October 2025 descending wedge pattern. We had a break higher over this pattern in October last year, a good break higher, or so it seemed at the time, but instead it turned out to be a false break higher, failing twice in late October and again in late November at the dark blue overhead neckline extension, currently 484.5, and that's of the August to September 2024 reverse head and shoulders bottom, forming a small double top pattern in the progress. The downside primary and secondary targets for this small double top pattern were duly reached in December last year. However, prices overshot the targets on the downside, dropping down below the bright red neckline extension. Yet, this neckline, along with the 50% absolute Fibonacci line at 445.5, eroded the bearish pressure at the time, such that the very start of the year has been the lowest we've had since March 2024. Prices have since risen sharply, creating a November 25 to January 26 diving board pattern. This is where from a fairly flat area running, the market initially dives down as if into a swimming pool and then climbs out of the pool. We've already reached the pullback target area in the 472.5 area in mid-January, with prices breaking up over both the green short medium moving average, currently at 465.25, and the mauve medium moving average, currently 469 even, but then halting at the flatlining gold long moving average, currently at 475.75, before turning lower and having a changeover gap lower between 457.75 to 471 even. As is not unusual, even for changeover gaps, the market has since the start of February tried to fill in this gap, but is running up into the same resistances we saw in mid-January. Green short medium moving average, which is just sitting there, the mauve medium moving average sitting there, the June 21 low at 468.75, and the 50% Fibonacci line, the May 23 to January 25 move at 467.25. We are trying to push up through these resistances today. If we do, and I suspect we might still do, then we still have what capped the market back in January, the flatlining gold long moving average, and then what capped the market in Q4 of 2025, and that's the dark blue neckline extension. Winnipeg Canola. Prices had previously been capped in November last year, unsurprisingly, by the then slowly declining medium moving average, currently 438.5, and the flatlining gold long moving average, currently 663. Further above to these is what may, in some ways, be the additional cause to this halt, and that's the significant bright green April to August head and shoulders top neckline, currently at 687.40. Now, please remember this feature and this neckline extension as it capping the market once again this week. Thus, at the end of November last year, we ended up with a small November and early December 2025 base double top, with the market subsequently crashing down and in the process reaching the primary and secondary targets for the small double top. I opined 8 weeks ago, and I quote, "Now in truth I favoured the basing action here, but it looks like the 50% absolute Fibonacci line is not going to stop the decline, in which case we could next be looking at congestion at 575. It all depends now on if the 606.90 50% absolute Fibonacci line, so that's the 50% Fibonacci line at 606.90, my bad English, apologies, whether that can hold, end of quote. In truth, the 50% absolute Fibonacci line did not hold the market, but it did erode the bearishness enough that we formed a small double bottom over the end of December last year and the start of January this year. The move up since the formation of that small double bottom has reached up to both the primary and secondary targets topside, and we have pushed up over the short medium moving average, the mauve medium moving average, the 50% Fibonacci line for the whole of 2025 at 655.70, which started to now act as a base, and more recently to be considered as part of a bullish halfway hesitation. Now more on this last bit should it develop. Plus, importantly, over the gold flatlining long moving average. We are right now being held down by the 38.2% Fibonacci line of the 2025 move at 678.40. But the real obstacle, and some may even consider it as a target, but the real obstacle is the bright green overhead neckline. That will be the key on the top side. Beyond that is the 50% Fibonacci line of the July 23 to September 24 move at 700.30. Bursa Malaysia crude palm oil. To start with, as I've done for most of last year and now into 2026, I'd recognise the wide congestion area that's overhead, between 44.08 to 45.59. We tried in mid-October last year to pierce it, and failed, with prices punching back down through the lower edge of this congestion as we exited October. On the way down, prices dropped down through another wide congestion zone, made up from the 38.2% Fibonacci line of the May 20 to March 22 move, and the 50% Fibonacci line of the May 23 to December 24 move, both at the same level of 42.74. Then the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39, and the July 23 high of 41.89 into a free area where the market created a small diamond continuation pattern. Now, the recent overall pattern had been the mid-August to early October bearish Andrews pitchfork. This had been pretty good at leading prices lower until we reached three bands of congestions below. They are the lesser Fibonacci line at 40.26 at 39.86, the February 2011 high at 39.53. I suppose in the big picture you could also include the neckline extension to the late May to April 24 reverse head and shoulders bottom, which is currently at 38.29. I know the prior three eroded the bearishness of this market, so I suppose the one below, this one that's below, also may have played a small role. However, the move lower within the bearish Andrews pitchfork was fine until two things occurred. The first is the construction of what can be seen as a triple or even a quad bottom over the November 25 to January 26 period, though I'm inclined to look at it more as a very, very complex reverse head and shoulders bottom. Now, this is a subjective judgment on my part, I realise that. This pattern came from and after the previously mentioned November to early December diamond continuation pattern. The second occurrence happened 3 weeks ago, with prices breaking higher from this complex reverse head and shoulders bottom and punching up through the upper tine of the bearish Andrews pitchfork. Since that break higher, prices overcame the previously mentioned congestion band between 41.89 to 42.74, and over both the gold long moving average, currently at 41.54, and the mauve medium moving average, currently 41.69, but stalled and turned lower at the end of January. Now, before dealing with that turn lower, it's worth noting the discussion I gave on the topside targets for that reverse head and shoulders pattern. I said 3 weeks ago, and I quote, "I feel it would be suitable to look at the 4100 area as a suitable point to start, hence a primary target X would be up in the 42.47 area, so not too far above, with a harder to reach secondary target X1 up in the 43.07 area. I'm not wholly in love with either of these two, but for now they will do." End of quote. Prices reached up and achieved both the primary and the secondary topside targets, and what was especially satisfying about the move higher was how prices rose up to just over the combination of 38.2% Fibonacci line of the May 20 to March 22 move and the 50% Fibonacci zone of the May 23 to December 24 move. They're both at the 42.74 level, reaching up to target X1 at 43.07, and the next session dropping like a stone, leaving behind a V-top at the end of last month. Thus, we are now back down just below the green short medium moving average and running along the top of the broken upper time, currently at 40.1313. Now, markets have a tendency to do that, to run along the top or just underneath the bottom of a pitchfork pattern. But I think this gradual move lower will once again meet those two supports that have held up the market at the end of last year. And that's the February 2011 high at 29.53 and a dark blue neckline extension to the late May 24 to April 25 small reverse head and shoulders bottom. It's currently at 38.29. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.